Now, there are different types of mortgages, and you may choose one type instead of the other, depending on your need. The first type is a fixed rate mortgage, and it's called a fixed rate mortgage because the percent interest rate is fixed for the entirety of the loan. For the entirety of the loan. Now, there are common plans in mortgages like the 30-year, 15-year, and then the 10-year plans. The 30-year and the 15-year plans are much more common than the 10-year plans. So let's say, for example, in the 30-year plan, you pay 10%. So you'd pay 10% every year, and that's fixed for the entirety of the 30 years you're gonna pay that interest. Now, there's a trend in fixed rate mortgage. The more years you go, you're gonna pay the loan, the higher the interest rate will be. So, in a 30-year mortgage, you'd pay 10%, but in a 15-year mortgage, you'll only have to pay, let's say, for example, 8%. Or in a 10-year mortgage, you'd only have to pay, say, for example, 6%. There's another type of mortgage called an ARM, or an adjustable rate mortgage. It's called an adjustable rate mortgage because the interest rate you're gonna pay every year is variable. It changes. It's not fixed like a fixed interest rate, a fixed rate mortgage. So the percent interest rate changes. Let's say, for example, you have a 30-year plan. You have a 30-year plan. 30-year plan. You have a 30-year plan adjustable rate mortgage at 8%. This means that for the first year you'd pay 8%, but in the next year you might pay something less, like 6%, or you might pay something more, like 10%. That's why it's called an adjustable rate mortgage. And one thing that's nice to know is that adjustable rate mortgages tend to have lower interest rates as compared to fixed rate mortgages. Why? Because fixed rate mortgages guarantee you security. You know you're gonna pay a fixed rate. You know the interest rate you're gonna pay for the entirety of the loan. While for an adjustable rate mortgage, you're not sure. You might pay 8% now, but in the next year you might pay something more, maybe like 12%. You might pay more, 12% interest. There you go. So that's an adjustable rate mortgage. Now there's a hybrid between an adjustable rate mortgage and a fixed rate mortgage. It's called a 5-1 ARM. So it's a 5-1 adjustable rate mortgage. The 5 means that for the first 5 years, you're gonna pay at a fixed rate. You'd pay in a fixed rate. Let's say you'd pay 8%. So for the first 5 years, you'd pay 8%, and the bank cannot change that interest rate. But for the succeeding year, 5 years plus 1, you'd pay at a different rate, depending on the prevailing interest rates of the bank. That may be more or less than your current rate. So that may be higher, 9%, or maybe lower, 6%. So that's a 5-1 ARM. To give you a better idea of how the prevailing rates are in our country, I looked it up online, and then for an ARM that changes yearly, you'd have an interest rate of 5 to 6%. For one that changes 2 to 3 years, you'd have an interest rate of 7 to 8.5%. For one that changes every 5 years, you'd have an interest rate of 9 to 10.5%. And then for one that changes every 10 years, for example, you might have approximately 12% interest. And these are the prevailing rates now, so they might change next year or the year after that. Now, a trend here is that for the first year, you must have a greater tolerance for risk. So, ARM that changes yearly is one that has greater risk because you don't know. You don't know if the next year you'll get a higher or a lower interest rate. So you must have a greater tolerance for risk or risk tolerance. But you'd also notice nga the interest rates for a 1-year mortgage is much less, and a 10-year mortgage is much more. So there you go. Those are the prevailing rates for ARM. Thank you for watching this video, and I'll see you next time. Ingat.